Welcome to the video tutorial Financial Cycle Case Study. This tutorial was created to give you an introduction to the financial cycle as it takes place in profit-oriented companies. The following topics will be addressed: phases of the financial cycle, presentation of the red tide case study, capital procurement phase 1, capital utilization phase 2, balance sheet extension phases 1 and 2, production of goods and services phase 2, capital recovery and new capital creation phase 3, capital outflow phase 4. The video tutorial will be concluded by a conclusion and an imprint. In this subsection, the financial cycle is outlined in general terms and divided into 4 phases. The first phase is the phase of capital procurement by means of external financing. According to financial terminology, this leads to a cash flow. The second phase is the phase of capital utilization, in other words, investment. According to the financial terminology, this leads to cash outflows. If purchases can be made on account so that payment can be made at a later date, the liabilities increase. The third phase has 2 components: the component capital recovery, also called disinvestment, and the component new capital creation. In other words, profit. In financial terminology, this leads to cash inflows. If a payment period is granted for sales so that customers can pay at a later date, the receivables increase. The fourth phase is the phase of capital outflow, also called definancing in the form of repayments and/or dividend payments. In financial terminology, this leads to cash outflows or, in case of losses, to a capital adjustment on the balance sheet. In the following subsections, the mechanism of the financial cycle will be further illustrated with the help of a case study. A student plans to produce and distribute a novel soft drink called Red Tide. From an inheritance, the founder has over 300,000 euros in liquid assets, which he brings into a newly founded company called Red Tide Drinks Limited. A bank provides the company with a startup loan of 200,000 euros and a term of 5 years. Please note, for reasons of clarity, interest and taxes are not considered in the case study. The facts related to the establishment of the company belong to the first phase, in other words, the capital procurement. The capital procurement is reflected on the equity and liabilities side. The funds paid in are shown on the asset side. The funds brought into the company by the founder are shown under the item equity as subscribed capital in the amount of 300,000 euros. The startup loan provided by the bank is shown under the item liabilities as long-term borrowings in the amount of 200,000 euros. Since both the funds contributed by the founder and the startup loan are called up immediately and paid in cash, the asset side of the balance sheet shows a bank item amounting to 500,000 euros. The balance sheet shows a total of 500,000 euros on both the assets and the equities and liabilities side and is therefore balanced. In the following, the focus is on the asset side of the balance sheet, which can show non-monetary and monetary assets. The composition of the asset side may change. Through business transactions, assets can be reallocated in 2 ways. First, capital release, and second, capital utilization. In the second phase of the financial cycle, capital is now being used. The use of capital is, like the release of capital, a subset of asset reallocation. In the course of the release of capital, previously non-monetary assets are converted into liquid or near-liquid assets. A reallocation of assets may also take the form of capital utilization. In this case, the reverse process takes place. Liquid or near-liquid assets are converted into non-monetary assets. In the following, the use of capital is explained both abstractly and then using the red tide case study. In a second step, the means of payments can be used to procure material goods, as shown in balance sheet T1. This is an asset swap. The balance sheet T0 represents the initial situation before capital utilization. After raising equity and debt capital, all assets are available in liquid form. After capital utilization, the equity and liability side of the balance sheet T1 shows the unchanged items for equity and liabilities. On the asset side, however, monetary assets were used for the procurement of material goods, in other words, changed into non-monetary assets. Let us now look at the implementation in the case study. The founder decides to make the following investments: the purchase of a building for 200,000 euros, the purchase of filling machines for 100,000 euro, the purchase of glass bottles, crown caps, sugar, and the chemical extracts E4711 and E0815 for a total of 150,000 euros. After the asset swap, the balance sheet is as follows. The balance sheet T1 shows an unchanged equity and liabilities side. The assets reflect the use of capital. The non-monetary asset area shows the purchase costs of the investments, that is, the building with 200,000 euro, the machines with 100,000 euro, and the raw materials and supplies with 150,000 euro. The section monetary assets show a reduced item bank with 50,000 euro. 450,000 euro were used to pay for the non-monetary assets. The balance sheet sum has not changed, since only asset swaps were made. The first and second phases, meaning the capital procurement and the capital utilization, may also coincide. Occasionally, investments are partly made on credit, meaning by using a supplier credit. This results in a balance sheet extension. Starting point of the consideration is again the balance sheet T0 with the known blocks monetary assets and equity and liabilities. Due to the utilization of a supplier credit for partial financing of the non-monetary assets to be procured, the balance sheet T1 shows a different picture. On the asset side, a part of the non-monetary assets was financed by the use of monetary assets. The equity and borrowed capital borrowed at time T0 remains unchanged. Another part of the non-monetary assets, here designated as plus delta non-monetary assets, does not have to be paid immediately because a supplier grants a payment term. On the liabilities side, the supplier credit shows up as plus delta liabilities. Although no more non-monetary assets are purchased in total, the balance sheet is extended. This is due to the fact that only a part of the monetary assets must be used for the procurement of material resources. Compared to a situation without the use of a supplier credit, this means that a larger amount of monetary assets remain on the balance sheet. Let us now look at the implementation in the case study. Long-time experienced wholesaler G predicts high sales and success potential for Red Tide. Recalling his own founding years, he unexpectedly grants the founder a payment term of 3 months. Therefore, the procured glass bottles, crown caps and sugar, as well as the chemical extracts E4711 and E0815 do not have to be paid immediately. The procured raw materials are financed by G's supplier credit. The payment terms result in a balance sheet extension. In the balance sheet T1, the asset side reflects the use of capital. The non-monetary assets area shows the costs of the investments, meaning the building with 200,000 euros, the machines with 100,000 euros, and the raw material and supplies with 150,000 euro. Due to the supplier credit, the monetary assets only had to be used to pay for the building and machines. The item bank therefore has a balance of 200,000 euro after payment. The equity and liability side shows the origin of the capital, including the additional supplier credit. The funds brought into the company by the founder are shown unchanged under the item equity as subscribed capital in the amount of 300,000 euro. The startup loan provided by the bank also shows unchanged under the item liabilities as long-term liabilities in the amount of 200,000 euro. The supplier credit taken out is also shown under the item liabilities as short-term liabilities in the amount of 150,000 euro. The balance sheet sum has increased to 650,000 euro due to the use of a supplier credit. The second phase is not yet completed with the procurement of non-monetary assets. In a further step, assets are combined with each other in the course of the production process and converted into sales products, meaning semi-finished and finished products. This is an asset swap as shown in balance sheet T2. Starting point is the known balance sheet T1. In the course of the production, parts of the non-monetary assets are combined with each other. The result is a reduced non-monetary assets area on the assets side, but also a new item, finished products. The balance sheet sum has not changed. The process of producing is purely an asset swap. Let us now look at the implementation of the considerations for the production in the case study. The founder starts the production, meaning the bottling of red tide. This results in the following production costs. Raw materials and supplies with a value of 135,000 euro are used in production. A building depreciation of 2.5% PA, that is 5,000 euro, is calculated for the depreciation in value. For the machines, a depreciation of 10% PA, that is 10,000 euro, is calculated using the straight line method. Wages and other expenses are calculated at 30,000 euro. The total production costs thus amount to 180,000 euro. For reasons of simplification, we make the following assumption. The supplier credit has been repaid in the meantime. After completion of the production, Red Tide Drinks has finished goods amounting to 180,000 euro. The costs and depreciation reduce the corresponding items in the balance sheet. In the balance sheet T2, the assets reflect the use of capital due to the production of the finished goods. After deducting depreciation of 5,000 euro from the original purchase cost of 200,000 euro, the building is still on the balance sheet with a residual value of 195,000 euro. Taking into account the depreciation of 10,000 euro, the balance sheet value for the machines has been reduced accordingly from 100,000 euro to 90,000 euro. The raw materials and supplies have been used up, except for a small remainder, so that only 15,000 euro are left on the balance sheet. As a result of the production process, the balance sheet shows the finished products valued at production cost. Based on the already known calculation, this results in an amount of 180,000 euro. For wages and other expenses, 30,000 euro have been paid out of the bank account, so that the item bank shows a balance of 20,000 euro. The equity and liability side is unchanged in structure and amount. In the third phase of the financial cycle, capital recovery and creation of new capital can be observed. The sale of finished products leads to a disinvestment process. The funds tied up in the finished products are returned to the monetary assets area. If more funds flow back than were originally used, a profit is generated, which leads to a balance sheet extension. The balance sheet T2 shows the already known picture taking into account the finished products. If all finished products are sold in full and all incoming payments are received in full, the balance sheet T3 shows a picture on the asset side without finished products, but with a significantly increased monetary assets area. If the sales price is higher than the production cost, there is a profit item on the equity and liabilities side. Let us now look at capital recovery and new capital creation in the case study. The founder starts the distribution of Red Tide. Within a short time, the drinks can be sold in the German club scene. All customers pay, as is the custom in the club scene, cash on delivery. A total of 250,000 euro net is collected. The sale resulted in a profit of 70,000 euro. The profit increases the equity. On the assets side of the balance sheet T3, the following picture emerges. The items buildings, machines, as well as raw materials and supplies show the balances already explained. The item finished goods decreases to 0 euro due to the complete sales of all products. The item bank increases from 20,000 euro by 250,000 euro to 270,000 euro. On the equities and liabilities side of the balance sheet T3, the following picture emerges. The items subscribed capital and long-term liabilities still show the same balances. The equity capital increases by 70,000 euro due to a new item profit. The balance sheet sum has increased by the amount of the profit from 500,000 euro to 570,000 euro. In the fourth phase of the financial cycle, a capital outflow occurs. It is in the interest of the entrepreneur to withdraw funds from the company. Existing liabilities must also be regularly paid back. Funds flow out of the monetary asset area. The equity and liability side is reduced to the same extent. A balance sheet contraction occurs. The balance sheet T3 shows the balance sheet by taking into account the complete sales of all finished products and after receipt of payment. In the balance sheet T4, the profit withdrawals and repayments are reflected on the asset side in reduced monetary asset area and on the equity and liability side in the reduced items for the equity and liabilities. Let us now look at the implementation of the considerations on capital outflow in the case study. The startup loan must be repaid in 5 equal annual installments. This means that the startup loan will be paid back with €40,000. After much deliberation, the founder decides on the following appropriation of profits. The profit withdrawal amounts to €20,000. The decided profit retention thus amounts to €50,000. The transactions result in an outflow of €60,000 from the monetary asset area. The equity decreases by €20,000. The long-term liabilities are reduced to €160,000. On the asset side of the balance sheet T4, the following picture emerges. The items buildings, machines, as well as raw materials and supplies show the balances already explained. The item finished goods has been dropped. The item bank is reduced by €60,000 from €270,000 to €210,000. On the equity and liabilities side of the balance sheet T4, the following picture emerges. The item subscribed capital still shows the same balance. The retained earnings are endowed with €50,000. The long-term borrowings have been reduced from €200,000 to €160,000 due to the repayment of €40,000. The balance sheet sum has decreased from €570,000 to €510,000 as a result of the outflow. In the case study Red Tide, the company's financial cycle and its essential mechanisms were exemplarily demonstrated. In summary, it can be said that the first phase of capital procurement leads to a cash inflow. The second phase of capital utilization results in cash outflows and/or an increase of liabilities. The third phase of capital recovery and new capital creation results in cash inflows and/or an increase of receivables. The fourth phase of capital outflow results in a cash outflow and/or capital adjustment. Essentially, the production of goods and services takes place in phases 2 and 3. It can be interpreted as a permanent process of investments and divestments, as well as profit or loss generation. The amount and structure of the stocks of assets, invested capital, as well as equity and liabilities, abstract capital, are constantly changing. First, purely asset-related transactions, meaning the purchase of raw materials, and second, transactions affecting assets and income, meaning the sale of finished products. Market economy organizations only fulfill their essential purpose when they generate profits and thus create new capital. Only an adequate creation of capital allows repayments, profit distributions, and an increase of the equity by retained earnings.